The broadcast is now starting. All attendees are in listen-only mode.
Welcome everybody to the Leaders in Housing Counseling call. We're going to get started in just a minute. Looks like people are coming on right now. So talk to you in just a minute. Okay, everybody. Thank you so much for joining us for the Leaders in Housing Counseling call. Today, Matthew and I have planned a little bit more relaxed call. We have a little bit of space, so we thought we might do a deeper dive into some of the policy issues that we're working on. Be very interested in your feedback. We will have an opportunity to spend a few minutes on several major emerging issues or long-term issues that have informed our work. So we'll have some space today on the call to do that. And I have learned, Matthew just taught me this now, that we love your input. If you put it in the chat box as opposed to the question box, then it doesn't become part of the permanent record. And we do really like to have what you write in your input, so we'd prefer you use the question box unless it really is a chat item. But, you know, for questions or comments, and we're going to actually ask you for some details on some experiences you might have had around language access. If you could be sure that goes into the question box. They're properly labeled on the right-hand side of your screen. That means we'd be able to get it as an ongoing record. Well, again, this is Bruce Dorr-Palin from the National Housing Resource Center. This is our Leaders in Housing Counseling call on Wednesday because we had a conflict tomorrow, but we'll get back on schedule for April. Today's agenda, we're going to talk about all that's happening around federal funding for housing counseling. There's a lot there and a lot that we need to get done. There's the CFPB is under attack in the House, and each of you can be very helpful in doing a small task that will help defend the CFPB. We'll do a legislative update. There's a lot going on in this field. That will include the housing finance reform, and we're going to spend a few minutes on that because the new legislation has come up, or the proposed legislation called Crapo-Johnson, or Johnson-Crapo. It's Johnson-Crapo. And so that's so we'll spend a few minutes talking about that. We have this discounted credit report, and we have an opportunity that people who want to be part of it should act on quickly. We wanted to make sure people knew and remembered about dealing with the CFPB Find a Housing Counselor website. It's going to be important in everybody's future. We've gotten some comments about HELOCs and the home equity line of credit, and we will talk a little bit about that. We'll spend some time on the language access question, and this is a place where we'll actually ask for some of your experience, and if you've had clients that have had problems with language access issues, we're going to take a small poll, but we also, which we'll use when we're talking with FHFA and CFPB, but we also would love to know if you've had experiences where people with non-English documents have been refused service by the documents have not been accepted by the servicer. And then we'll have the latest on HSBC and their new loss mitigation stuff that we pushed them to do, and many of you participated in. And of course, we would love you to join NHRC and strengthen our movement. So let's dive in. So Matthew, why don't you give us a picture of where things are at on the new budget and what we're doing on housing counseling?
Yeah, thanks, Bruce. So just to start with a kind of a recap, we went over this a bit on the last call, but just want to make sure that everyone's on the same page. So a couple of weeks ago now, President Obama released his budget. You see the numbers on the screen there relevant to housing counseling. So he included $60 million for the HUD housing counseling program, which is up from this fiscal year, $45 million. But then kind of offset that with a cut to NFMC, which he proposed $50 million for NFMC, which is down from $67.5 million from the current fiscal year. So all in all, it would be a net loss if the president's numbers were enacted. It'd be a net loss of $2.5 million for housing counseling. The way we were kind of expecting there to be this transition from NFMC to HUD housing counseling, and we've actually encouraged it with the caveat that we're not encouraging there to be any loss for, we don't want to see an overall reduction in funding for housing counseling. But as you all know, HUD housing counseling dollars are more flexible. Agencies can use them as they see fit to cover any variety of costs, whereas NFMC funds are really limited. And it's also just a more sustainable source of funding. NFMC, you hear from people on the Hill a lot that it was meant to be initially just a one-year program, and we're now several years in. So NFMC, it's not a permanent source of funding. So we're happy to see the transition to HUD housing counseling funding. Again, with the caveat that we're not happy to see any kind of reduction. So the last time we talked a couple of weeks ago, we didn't yet have our kind of asks nailed down, which we do have now, and you see at the bottom of the screen there. So we're going to push for $60 million, the President's ask for HUD housing counseling assistance. Then we're also going to push for level funding of NFMC. We're going to ask to keep it at 67.5. So overall, those numbers would mean a net increase of $15 million for housing counseling. So what are we doing to get these numbers enacted? So the first thing, the thing that we're working on now, and hopefully you've all seen by now, I circulated on Monday evening a sign-on letter. We're going to be submitting that to every member of Congress next week. Really can't stress enough how important it is that we have absolutely everyone on this call, and we're going to go well beyond this call to make sure that we have. I would like us to have 500 or so agencies signed on to the letter. The reason is members really care, and people, I don't know if everyone appreciates this, but members care what their constituents say. And so when we submit this letter, if the representative sees it or the senator sees it, the first thing they're going to look to see is if there's agencies from their district or from their state signed on to the letter. If there's a good showing of support from their district or their state, there's a good chance that they'll include these numbers in there. So at this stage, we're asking in the letters for members to include our asks for $60 million and $67.5 million to include that when they write their letters to the Appropriations Subcommittee. So every member of Congress will send these letters to the various Appropriations Subcommittees and ask them to support different funding levels for different programs. So if they see 10 agencies from their home district signed on, there's a good chance that they include that in their letter to the HUD subcommittee. If they look and there's no agency signed on, they may well not include it. So really can't stress enough how important it is to get everyone on the call signed on to this letter.
Senator Feinstein told us that they would not submit it unless they'd gotten in writing requests from her senatorial district, which of course is California. But there may be other senators that take that view.
Absolutely. And there's already a request, and I'll definitely circulate the letter and the link to sign on. To sign on, it's just a very short SurveyMonkey that asks for your name, your agency name, contact info. It takes a minute to sign on. So we'll be submitting that next week. One really cool thing that we're doing with the sign-on letter that is kind of new to us this year is we're personalizing it to every member. So rather than just citing national data on the number of foreclosures there were last year, Senator Feinstein will see the current foreclosure rate, and there are this many homeowners in California who are seriously delinquent, this many foreclosures in California. So bringing it to the district level or the state level really will make a difference for them. We'll also are going to highlight for each letter the groups that signed on. So we'll put all the California groups first in our letter to Senator Feinstein, and do that for each senator and each member of Congress. So we think that will make a big difference as well. So again, we'll recirculate the letter and the link to sign on after the call. But it's really critical that we get everyone's support on this.
And what's the exact deadline? When do we need this in?
By Monday at noon. It's time sensitive. We thought about doing Friday, but we to give people as much time as possible. We realize it can be a slow process for some groups. You have to go get clearance from different members of your organization. So we wanted to give you enough time to be able to sign on. But it's critical that we get these in as early as possible so that they're on the decision makers' minds. So then just a few other bits of our advocacy strategy for federal funding. We'll be doing, after we get these letters submitted, we'll be doing Hill visits. We already did this about a month or so ago now, but now that we're further along in the process, we'll meet with both the House and Senate, people from the members who are on the appropriations, on the THUD subcommittees in particular. We'll also meet with the permanent staff members from the appropriations committees who are really critical. They're the people that are, really into the nitty-gritty of the appropriations process. So we'll be meeting with those folks and be pushing for funding for housing counseling there. There will be, I think, probably next week, we're working with some of our colleagues, in particular, some of the folks from the Coalition of HUD Intermediaries, working on getting some member of Congress. We have a few ideas of who exactly that will be, but to circulate a Dear Colleague letter asking for funding for the HUD Housing Counseling Program. Those are really powerful. If we can get a good number of members of Congress signed on to a letter, that will definitely carry some weight. I'm sure in the coming months, really, I'll be doing some targeted outreach to folks on this call, asking if you can make an additional call or send an additional email, do some extra steps for some key members on the appropriations committees. And then we'll also do a national sign-on letter that we'll circulate probably in the next month or so. I would be my best guess. But so that's all that we have planned. It's obviously federal funding is one of the most important things that we work on from an advocacy perspective, and it's something we take very seriously. So we're looking forward to working with all of you in this process.
Yeah, and we're coordinating with the Coalition of HUD Housing Counseling Intermediaries, and we're glad to coordinate with anybody else as well. I mean, we're really trying to have a joint and clear voice on the same page around these issues, so that there's no sense that there's divisions in the housing counseling community. To speak frankly with you, because we're all friends here, we understand that the NFMC budget is under a lot of pressure, that it's viewed as Matthew said, as temporary, so that we might not get the $67.5 million we're doing. We didn't want to be in the position of arguing for a decrease and wanted to argue for it being as high as possible. The President's budget, of course, was at $50 million, so that's a big difference, and we are very pleased that the money migrated, most of the money migrated into the HUD Housing Counseling budget. There's been some concern that NFMC might be terminated, and we think that's not the case. We think the administration is working on a sort of a gradual wind down. We think that's a way better way of looking at this, so that funds can flow to HUD Housing Counseling, and there's more of a transition. So we'll encourage that view in the administration, but certainly the word we've heard so far has been encouraging, and we should just expect this to be a gradual process. And our real job, as Matthew said, is to really defend housing counseling in terms of its performance and value, and really communicate from the local district to your congressional people. And we've emphasized this a lot, but sort of what the battleground is on this particular funding is not with the Democrats, it's with the Republicans. So good to talk to the Dems, but in fact, you're counseling people who come from Republican districts, maybe coming from the suburbs, the rural areas. Most of your organizations have a pretty broad reach, and we really want to be able to. We're hoping that you're reaching out to those congressional offices as well to do calls and support. And Matthew will signal you when the right time is to do calls on this. But that kind of relationship building, as much as supportive as the Democrats have been, and we love them, we need to build more support among the Republicans. And on a one-on-one basis, they often get this pretty quickly. So there's a lot in common of what we do, and the ideas around individual wealth building and protecting the family and things like that are a good match. Okay.
And just,
yes.
Sorry, just one other thing. We have also put out a few requests for local data to include in those sign-on letters that are mentioned in point 1 there. Haven't had a huge response. If anyone has any data that would be appropriate to include. So an example would be if you have any information on first-time home buyers in your state, anything that we can include that we can say, in Ohio, there were X number of first-time home buyers last year that would benefit from housing counseling, or anything in that vein that helps us to make the case when we're trying to make these local arguments for why a member should support housing counseling funding. It would be very helpful. So if you have anything like that, please just shoot me an email.
Great. So next on our list is that the CFPB is under attack in the House. So Matthew, just give us a quick rundown there.
Sure. So there's really it's all in the House. And it's really the far right in the House that's kind of leading the charge. And I imagine people on the call know that the far right was opposed from the CFPB from the beginning, and they've not let up. But just two things to kind of report on. The first is they passed maybe a couple weeks ago now. I forget exactly the timing of it, but in the House they passed H.R. 3193, which is really it's not going to pass the Senate. It's largely symbolic, but would really undermine CFPB's independence. It would do things like replacing the director with a 5-member panel, so just kind of dispersing authority from Director Cordray. It would, right now the CFPB isn't subject to the congressional appropriations process. It has its own independent funding. It would subject CFPB to the congressional appropriations process. That would allow, obviously, conservatives to try to zero it out and kill it through lack of funding. There's a few things like that would, if they ever came to pass, would seriously undermine the CFPB, but fortunately that won't pass the Senate. The other thing, and the thing that we're asking you to take some action on, so Representative Henserling, who's the chairman of the House Financial Services Committee, he's put up on the House Financial Services Committee website basically a survey asking for negative stories or negative feedback on CFPB. We're trying to counteract that by asking folks to submit positive stories about their experiences with CFPB. So I sent the link out earlier this week, and the link is there, and we can recirculate it. We are trying to keep track, though, of who submits positive stories, and just try to track what people are saying. So if you're planning to do something, if you could just shoot me an email so that I know that you're doing it and I can follow up to get a record of what you had to say, that would be really helpful. But you see the website there, and it's just important that when they launch these attacks, CFPB is doing a lot of important things, and they're the agency that's looking out for consumers, and a lot of, there are a lot of interests that would like to see them fail. So it's important that we defend them to the extent that we can.
Great. And occasionally we've talked about having dealing with the public narrative, where it's what people hear in the media, what politicians can say. This is one of these places where we're trying to impact the narrative so that a more positive, progressive regulatory viewpoint comes out that can be helpful here. Good. So let's do a deep dive into housing finance reform. So the last year, Corker-Warner was introduced, which was a bipartisan bill to revamp or take over Fannie and Freddie and create an alternative securitization platform and program called the FMIC, standing for Federal Mortgage Insurance Corporation. So FMIC, Federal Mortgage Insurance Corporation, and you'll hear FMIC in these conversations for a while. So that was a breakthrough in some ways, and was a real compromise in many ways that will really change the way that housing reform is done. But one of the key issues is there's going to be a government backstop. Will the government, at the end of the day, when things go really bad, guarantee mortgages? And if so, then it's much more likely that you'll have a 30-year mortgage. That's what the function of Fannie and Freddie was in the past, though they said it was an implicit rather than an explicit guarantee. The new institution, whenever it's created, would have an explicit guarantee, and there would be contributions to a fund to make sure that that gets maintained. So the chairman and ranking member of the Banking Committee announced that they were going to do their own version of the bill, and it's called Johnson-Crapo, and it's essentially using the framework for Corker-Warner, but putting in a number of its own unique aspects. So I'm going to talk a little bit about some of the things that are contained in here, and there'll be other opportunities for discussions. We'll bring experts in over time so that there's a more comprehensive analysis of some of these elements. But I thought it'd be useful for you to know what the terms are. You'll see some of this in the news media. Some of this we'll want to definitely comment on and be engaged with. And we also want to think creatively about how to incorporate housing counseling. So the first thing that's gotten a lot of attention is that there is a 5% down payment requirement. In Johnson-Crapo, they have an exception that there could be a 3.5% requirement for first-time home buyers, so that it doesn't have to be the full 5%. So it would match the FHA down payment rule. And our position has been, and I think will remain, that we don't want to see that the we think that the legislation should not be used to define what underwriting standards should be, and that the lenders and the securitizers should decide what the underwriting should be, and that there should be an availability of loan products that don't have as high down payment requirements. And there is, strong support on the Democratic side, but very strong opposition on the Republican side to that viewpoint. We'll continue pushing this, but it's an important issue. And I think while 3.5% for first-time homebuyers is an improvement, there are many problems with it. So one of which is that if you're in a high-priced market in San Francisco, in New York, Boston, Washington, D.C., Miami used to be that way. It looks like it's getting back to that way. What the problem is that it's very hard for low and moderate income people to get 3.5% of a highly priced building. And if you add to that all the closing costs that people have to bring in, it becomes an insurmountable barrier. And to get low and moderate income home ownership, you really need to make sure that you can adjust it in ways that really work for the marketplace that's there. Barry Zegas also pointed out an interesting other problem with it, which is if you are a first-time home buyer, you get a you have a 3.5% down payment, and then in the next year, interest rates drop, and you want to get a lower rate, you would have to you'd have to have 5% down. You probably wouldn't not have accumulated enough equity to do that, so you wouldn't be able to access the current rates. And I mean, there's sort of all those kind of assumptions built into this. But we are looking for a much more flexible down payment, and then this shouldn't be legislated. So that's our position. As a backup position, if we can't get any progress on that, then we'd be interested in, yes, you have a 5 or 3.5% requirement, but make an exception for people who have completed housing counseling. And looks like there was a discussion in the NCRC group about potentially doing that as well for Community Reinvestment Act loans. So we'll see where they come out with that. But interesting opportunities here. And affordable housing goals is one of the things that Fannie and Freddie Mac had, which meant that they had to have a certain percentage of their business that went to meet affordable housing goals, both in single-family and in multifamily. That gets replaced by a market access fund that provides money for meeting affordable housing needs. Not as strict as affordable housing goals, but a lot would depend on what the criteria is to see if it actually gets to be something equivalent. And one other thing that was most specifically that came in, it was this weird provision that said that they had a variety of prohibitions about what funds coming from the FMIC could be used for, one of which prohibited the use of personal counseling services. So we didn't know what that meant, and have had a hard time getting that defined, but we were concerned that that could prevent housing counseling from being a funding source. And in Johnson Crapo, they did hear us loud and clear, and it very specifically says that housing counseling would be an eligible use in some of the grant funds. So small victory in the world. We did not make progress on getting housing counseling incorporated into the underwriting formats and into the servicing. We'll continue to try to raise those and see if we can make some headway there. But on the whole question of access to credit, so they have expanded from Corker-Warner, and the new Johnson Crapo bill has included in a clear purpose of access to credit, that you have to meet you have to serve all communities and during all credit cycles, and they have a number of mechanisms to address this. But one of them is they've added the Office of Consumer and Market Access, and it does a couple things. So this office would do an annual assessment of the marketplace, and this would be a performance assessment, and it would rank the performance of each of the individual originators that come into the program, and the ones that are the top performers would be the highest rank, and the lowest performers would be the lowest rank. And they would also rank them by how well they address the market needs, and I'm assuming that's market share. So it'll be a peer-to-peer ranking based on how their peers do, and it'll also be a ranking on how they do in the marketplace. And then they have this incentive thing. They call it a market-based approach, and it's basically that there's, on average, each of the lenders will be paying 10 basis points as a fee on the loans that they are making. That money would be distributed to the National Housing Trust Fund, to the Capital Magnet Fund, and the Capital Magnet Fund would be for like CDFIs to do creative lending. And then the new Market Access Fund, which would be the fund for helping underserved markets. So this 10 basis points, the way it would become an incentive is that if you had a higher ranking, you would have to pay less of that 10 basis point fee, and if you had a lower ranking, you would have to pay more of it. So it could go as, so with 10 basis points is the average, so it could go as low as 6.5, as high as 13 points for any individual originator. And the so the idea is that it costs more, their loans will cost a little bit more if they're not performing well in the accessing the market area. So a whole new untested world there, but a creative idea. So they have servicing requirements in there, but it looks like it kind of parallels what the CFPB does. And so I guess our view has been that CFPB hasn't gone far enough. And one, frustrating example is that it doesn't, the CFPB didn't require servicers to provide an affordable modification if somebody qualified. So it's where CFPB comes right up to that point, but it's really not mandated that people get offered an affordable mod. So things like that, we're hoping to see that get into the legislation. We'll see what happens in the future. The government will provide the securitization. It's called a common securitization platform. And in the past, Fannie and Freddie did the securitizations. And now under this, there'd be one common platform. That would be the FMIC. And it's looked at as a utility. It's kind of a neutral body that would provide the securitizations. We think there's a real opportunity in there because they'll have standard PSA, standard pooling and servicing agreements. Those are the regulations that, it's the contract between, actually between the borrower and the originator and then the securitizer that defines what can be done. And those PSAs, those agreements in the past, had lots of little different tweaks to them, and that meant that some people could get principal reductions, some couldn't. Some people could get interest rate reductions, and some couldn't. And all that crazy stuff, this would create a uniform playing field. And we've argued that just all the lost bid opportunities should be available to everybody. We don't know if that'll be included, but that's kind of been our position, and that does create an opportunity there. Private capital will be in front of the government guarantee, so that if there's a loss, the private capital will take the loss first, and government is the backstop. It's the final step that if things go really bad, as they did a few years ago. They have a special portion where they're going to provide access for small lenders, and so the way they do this is by saying that the pricing of getting your loan securitized cannot be done based on the volume of business you produce. So that in the Fannie-Freddie world, you're a higher volume producer and your fees were less. That made it a lot harder on community banks, which then would have to pay more for their loans, and as a result, their loans are a little bit more expensive. This was a way to address that. The Fannie and Freddie, they've set out a 5-year timeline to wind down Fannie and Freddie, but interestingly enough, nobody quite knows how long it will take and how much work it'll be. So there'll be there's an unlimited number of 2-year extensions built in if more time is needed. There's a multifamily provision, and the groups working in the multifamily world have really worked very hard here. And essentially, they would take, so there would be the current business that Fannie and Freddie does would be sold to new owners, and they would operate as lenders, as guarantors, and they could also aggregate loan packages to guide them to being securitized. So that would, set up a new business there to do the work that Fannie and Freddie used to do, which were major players in funding multifamily housing. In the multifamily world, if you were going to get the government backstop, you would have to provide 60% of all units would have to be affordable to 80% of LMI, so that there'd be a strong affordability provision built in. So that's kind of a very high level on a number of these issues. and we will continue talking about these and raise lots of concerns. I think we're very interested in two elements here, one of which is making sure that that there's broad access to mortgage lending in the United States, and that there's a real affirmative to meet all the needs of the community. One of the controversies in the current legislation is they don't really say anything about communities of color. They talk instead about underserved communities, and they specifically include rural, which we think is a good thing because it's been an area that's been neglected, and it was part of what we did lobby on that as well, but doesn't actually specifically talk about where the biggest flashpoint is, which is in communities of color. So we'll want to learn more about this. I'm sure this was a tactical decision that was made. But, well, actually I shouldn't say that. There was a lot of negotiation that went on this bill, and a lot of things happened and that changed because there was an effort to, on the Republican side, to really tone down some of the more progressive elements. And then the first thing is we'll work hard on improving market access or access to credit. The other part we'll continue to really push to try to get housing counseling built into different aspects of this work. So it'll be an adventure as we're going along. You'll be part of it. I'm sure we'll get some people to talk to us about it. We'll be doing some lobbying on it. And, and actually here's the other thing, which I'm sure is on some of your minds, which is this actually going to pass into law? And the reading of the tea leaves is, if it was able to get out of the Senate, big if there, there's no way it would get out of the House this year. But the reason this is important is because you're really laying the foundation, and anything that happens in the future will be based on what was done in these sessions as well. But these will be the starting points. So everything we can get into this legislation that improves your ability to do your work and improves opportunities for low and moderate income and communities of color and housing consumers in general, those will be the basis for whatever gets done in the future. So we do want to be engaged with this, even though we know this may not be the final legislation. So let's move on here, and please let us know if you have questions or comments. All right, so the Mortgage Delinquency Forgiveness Tax Relief Act, been around for a while with us. So what's happening here, Matthew?
Unfortunately, there's not a whole lot happening, which is exactly the problem. So just to recap, I imagine everyone knows it by now, but this is the bill that was in place from 2007, I believe, until the end of 2013, and protects homeowners from having to claim a principal reduction as taxable income. So if you get a $30,000 write-down on your mortgage, without this bill, you have to claim that as $30,000 worth of taxable income. So this is obviously especially urgent with the deadline for taxes coming up right around the corner, and so it's really important that we continue to put pressure on members of Congress to act on it. Again, the problem with this bill has never been a lack of support really on either side of the aisle. I mean, there may be some real stalwarts far right and who object to it, but by and large, it's got broad support. It's just been a matter of being kind of a victim of the difficulty getting a package of tax bills passed, and then the alternative being trying to get it passed on its own. So it's been more procedural hang-ups than any real opposition to it in principle. The kind of important change that's happened over the last, it's probably been a month or maybe a little bit longer now, is that former Senator Baucus used to be chair of the Senate Finance Committee. Now left to be ambassador to China, and his replacement is Senator Wyden from Oregon. He's the new chair of the Senate Finance Committee that would need to move this bill. So he's really the most important target at this point. I'll be doing probably next week some outreach to Oregon groups. AFR, Americans for Financial Reform, is doing a lot of work on this as well. we'll probably are going to try to organize some in-district meetings. There's a break for Congress coming up in the next few weeks. So anyone on the call from Oregon, you can expect to hear from me shortly on this. But really, it's not just folks from Oregon. You know, again, the members care what their constituents say. So if you haven't, or even if you already have made a call or sent an email on this, it's really important that we just keep the pressure on every member of Congress and let them know that this isn't an issue that they can continue to fail to act on. I mean, it's going to hurt. It's going to prevent people who could really benefit from a principal reduction. It's going to, in some cases, it's going to prevent them from being able to have that benefit, and will probably result in some folks losing their homes. So, please act on this. Make a call, send an email if you have any questions. I'm very happy to work with you and can give you some talking points. Do anything that I can to and I know not everyone is used to making those calls to their members' offices, so we're happy to work with you to make it easier.
Okay, so there's been a flurry of activity on the leaders list about this question, but the credit report discount that we've got, I'm afraid, is under some real pressure. It's going to go up, probably substantially starting April 1. And so there's been a lot of interest in trying to get in under the wire, and we would really love it if you would do it. So this is an exclusive to NHRC members, but it's easy to join. The membership dues chart is on our website. You can always email Matthew or me. We'd be glad to send it to you. We're doing a lot of great work, but this is also a very time-limited offer, unfortunately. So it's $9.75 right now. It's all three major bureaus with the scores, and you'd really have to. If you get it in April 1, it's too late. It has to be in March still to get the discount, and of course you have to be a member first. But we'll work with you. Here's an interesting thing which has come up with a few groups who are like, well, you know, I really want the savings, but I'm really happy with my provider. I don't want to lose the quality of the credit report I get. Well, first thing to know is that my experience is I've been doing credit reports since when? 1986, 87. And I often bid these out and got to look at the different credit reports. The feed from the credit bureau is the same for all the consolidators. And if you ever chatted up with them and talked to them about it, which I got to spend way more time than I wanted to doing this, I mean, they would all admit it's basically it's all the same information. And then CIS, who is the provider we use, does provide a customizable report, and many of the agencies do, not all of them do, but many of them provide a customizable report, which means that you could ask that it be structured or you could organize it by delinquency, you could organize it by address, you could organize it by most recent. You can get listings of the how to reach the vendor/creditor. With contact information built in. I mean, there's a bunch of things that could be done. CIS does this. A lot of the others do it as well. But here's the thing that you can do if you're worried about doing the shift over is there's no reason to cancel your old contract, all right? So what you would do is you could sign up for CIS, try it for a month. If you're unhappy, go back to the other one. I'm pretty confident you won't be. It won't be a big change for most of you, and they do have a very good level of service. So just wanted to put that feed out there for you that this is that opportunity. But we've got to act on this now, and they have gotten a bunch in already, so that's great. What I'm really hoping between you and me is that we can negotiate down the any increase because we've gotten a big surge in business, and that we'll have more volume going on in the future, which will make it easier to keep discounts and keep them lower. All right. So next on the list is the so the CFPB Find a Housing Counselor website. So I think most of you know that CFPB in its regs is requiring that servicers notify that originators and servicers provide lists of housing counselors to, or housing counseling agencies. We actually got them not to provide counselors, but agencies specifically, but they would supply these to people who are making loan application, people who are having delinquency on their mortgages. And this is a powerful tool for us, but it's only as powerful as it is if you're properly listed on the CFPB website. So we did a push on this last fall and found a lot of agencies, or some agencies, that weren't listed or were listed with incorrect information. Most of those problems actually led back to your listing in HUD, and it's an easy fix there. You go to your point of contact, or whatever the GTR term is now. You go to that person and work with them to get your listing updated. But we did find several that were problems communicating between HUD and CFPB. Some of those problems we've been able to fix systemically. And for a number of agencies, they just learned that for one reason or another, they weren't listed properly in the HUD website. So this is really important. The link is right there on the screen, but you can go to the CFPB homepage and just put in "Find a Housing Counselor," and I think it's "Find a Housing Counseling Agency," right? Whatever it is. I think it is "Finding Housing Counselor," but whatever it is, just put that in, and yeah, it's there on the screen. So put that in, get to that page. You've just put in the zip code for the agency you're trying to figure out, and you'll see the list. Hopefully, you'll see the listing right away. So please do that so that we're properly prepared when this starts up with the industry. And if there's problems, and you've dealt with HUD and that's not satisfactory, please let me know right away. We did get pretty good turnaround from the CFPB about getting these fixed, and I'm committed to make sure that we try to make this work 100%. So I'll personally get involved in these. Okay, so let's see. And everybody knows that the NOFA is out for HUD housing counseling funding, and we've gotten a number of calls for agencies who are looking for an intermediary, and we're glad to be helpful in any way we can and try to link up and provide relationships. And if I know, we'll help you identify people to talk to and whatever. We do have a pretty out-of-date, not perfect, but helpful in some ways, piece on our web page, and the link, Matthew's put the link up on the screen there. The agencies, what's helpful, I think, about this is we list a few agencies that are looking. I think that list may have changed a little bit, but some of these agencies need some lead time. But there's a number of questions that are answered for a few of the agencies, but that might be helpful for you in figuring out what questions you want to be asking any intermediary that you're talking with. You really have to do this right now. I mean, it's not like this could happen quickly or at the last minute. It takes a couple weeks typically for them to do it. So this is a project. If you're at all thinking about this, you really need to start this afternoon. And again, we're willing to be helpful, but and you can use this page as a resource, but certainly it doesn't cover all the agencies that might accept new servicers. And when we wrote this up with new intermediaries, when we wrote this up, it didn't include all the intermediaries. There's been a raft of new intermediaries that have come down in Minnesota, California, New York. I'm pretty sure New Jersey is coming through. All of those are new opportunities. Okay, so on the home equity line of credit, Melinda Opperman has brought this up from Springboard, and it's really worth noting. So there was a major push in the industry, in the financial services industry, to get people to take HELOCs, and according to Lender Processing Services, 3/4 of the outstanding HELOCs were actually taken out between 2004 and 2009. And I mean, HELOCs can take many shapes and forms, but many of them had either loan life terms of 7 to 10 years. There was a whole model of some which had initial 10-year interest only, and then would go to a full principal and interest payment record. So some of these need to be refinanced. Some of them you're going to get a major rate shock because you'll be suddenly charged for principal. And this is an emerging issue that counselors need to be aware of and thinking about what we should be doing to protect homeowners who had gotten into these loans, and who maybe an issue that we'll all be dealing with for the next couple of years. So our goal here is that wanted to kind of alert you to this, and hopefully we'll have some ability to have conversations in the future about what the best strategies are for these folks. You know, obviously in a tighter credit environment, you can't easily refinance as easily, so we'll be need to think about what the best strategies are. Okay. So here's one more deep dive, and I guess we'll do this quickly then, on language access for limited English proficient borrowers. So we've been doing a lot of work on this in the past year, and I've been a little frustrated about not making more progress. So many of you have reported problems of people not being able to navigate the mortgage and or servicing systems because of language challenges, language barriers. We've put together a pretty specific list of what we think needs to be done, but we're very open to new ideas. National Capacity has contributed a lot to this conversation, NCLR. Song Hutchins has been really active in this, a variety of people. So let me just dive into sort of the ideas that we've been talking about, and we're very open to more ideas that you've got about what we need to do to solve these problems. The first one is that servicers should provide free oral interpretation. So I think we all call this translation, but oral interpretation is now the term of art. And the idea would be that if somebody has a language challenge, that they match up their single point of contact to speak that language, that they have staff that are prepared to be able to speak the language, answer questions, and be knowledgeable. And we've had a lot of bad experiences in that part of the field. So that, and this actually, in the context of this is that we're presenting these ideas to the CFPB and to FHFA, and we just have started the process with both of them a second time. This is a new round from last year. So the second one is that language needs should be marked and flagged in the servicer's files so that they know that it should be a requirement that the servicer knows what the language needs of the household is, so it's easy to match them up with the right services. And then that they translate documents into the appropriate language, which sounds obvious but actually doesn't happen a lot, and I mean, there's some legality issues that would be really helpful if the regulators simply sorted out and fixed. That they define a list of basic languages which each servicer must work in, and so that, you know, it's not only that you have English capacity, but everybody has Spanish capacity, and there needs to be a defined list of what the other languages might be, but there's some core languages that are common enough in the United States that they should be done. And we're probably not talking about, you know, 20 languages, we're probably talking about 5 or 6 languages there. But that the second part is that if a sizable portion of the servicer's territory or their customer base has a different language need, that they should be meeting that language need. And so what we're thinking about here is that you don't have to have national capacity to meet the Hmong language needs, but you do need to meet it in Minnesota. You do need to meet it in parts of California where there's a concentration of populations, Somalian, I mean, those sorts of things, so that there's some matchup between what your base looks like and what in a more local location, a more local capacity. Accepting key documents in language. So, you know, you all brought these issues up, but Social Security income documentation can be in Spanish. And services not accepting it has caused lots of problems, we know, for people and for the counselors. Bank statements. So in Puerto Rico, homeowners have to hire translators to translate the bank statement to submit it, even though, you know, this is a common business practice in Puerto Rico. Hardship letters. You know, it's a lot to ask people to write a difficult document then in a language they don't understand, and sometimes require them basically to trace words that they don't know what they mean. And then the HAMP RMA, it's in Spanish. They now have versions in other languages as well, getting the servicers to accept those documents. So here's my quick question for you before you hang up. We'd like you to go into the question box and write down where you've had an experience with a servicer who's refused a document because it wasn't in English. And it would be really helpful if you would just say what the document was and which servicer was it. And what's happening is that when we're talking to the CFPB and to the FHFA, they're asking us, well, who's doing this? Where have you seen this problem? And my information is actually kind of a year or two old now, and so what we really need is the most up-to-date. So please go to the question box and just where you've had that experience of servicers not accepting documents in Spanish or in any other language. This can include the hardship letter. It can include bank statements. Wherever you've had this experience, please put it in the box for us. Okay. One of the things which actually was raised by the public interest in attorneys was that there be some private liability for servicers, which in effect means that there, if a borrower is materially damaged by these events, that you could sue in court for this. And one of the things that we've really found is that individual enforcement is very difficult. The CFPB doesn't have the capacity to deal with each case. FHFA doesn't view themselves as an individual enforcement agency, so having some ability to sue would give people some recourse. Okay, we now have a poll, and I want to really just ask people, because we will use this in our meetings with CFPB and with FHFA. So in the last 3 months, have you had a client who has experienced problems with their servicer because he or she was not fluent in English? So please come out and vote on the poll right now. How are we doing? We're ready? Okay, good. I got the thumbs up from Matthew, so we're good to go. So Matthew, what are the poll results?
Yeah, I guess we should have a short-lived poll. Let me hold on 1 second.
Okay, there we go. Okay, so 26% of the respondents had the problem. 74% had no. That's excellent. I mean, that's a very helpful number, and it's one we'll use in these conversations. Very good. So very quickly, we need to bring this to a close. So we'll do more work on language access. Please send us anecdotes, experience. If you have some data, that's great. But anecdotes are very helpful right now and certainly informed our work. If you've got thoughts about tightening up these principles, let us know about that as well. All right. So let's see. On HSBC, so as longtime followers have seen on HSBC, we got major changes in HSBC's Lost MIT program. They did away with that horrible 6-month forbearance agreement, and now people can at least get a 2-year mod as the first step in the waterfall. The principal reduction is part of that as well, and they could get as much as a life of loan resolution. And we've eliminated a bunch of the most problematic elements, and there's still a lump sum payment, but it's not 40%. It's 3 months of the equivalent of the trial period. That is supposed to go into effect on the 20th. That would be tomorrow. If people had problems with cases that were in the pipeline and I did intervene on a few of them with you. Starting tomorrow, that should not be a problem, and that should be the standard of business that we're seeing on the we're going to be seeing with HSBC going forward. So one, want to make sure that let us know if there are problems with that, because we'd be happy to escalate them to the senior people. Two, let us know it's not in place. And then three, they're going to do a training workshop for us, and we'll cast the net widely. There'll be more information about this, but the training will be on April 24th, and will be around their loss mid programs. We're continuing to push that they do what every other servicer does, which is 3 months of trial mod payments rather than 3 months of a lump sum. They are very stubborn, but in the meantime, we still have made some progress, and you should be able to take advantage of it. Okay, so please join NHRC. We've actually had a rush of members in the last month around the Leaders Conference and around the credit report discount. Please join before the 1st, and let's try to get you into the credit reporting program. This will help us all. But you know, your being a member is what supports and strengthens our work and allows us to have the flexibility to do the kind of work that I think all of us would like. So thanks a lot for all your support out there. We really appreciate the work you're doing and the information you've been providing. All right, have a good rest of the week. Bye.